Hi, welcome to this video, which is all about Forex stop losses and 10 simple rules that if you incorporate them in your trading strategy, they will help you maximize your profits and keep your losses small. Now, in terms of most traders, they make the fatal error, in my view, of putting all their energy or focus into trade entry techniques. Now, obviously you need good entries, but most traders just do the stop as kind of an afterthought. There's no specific rules in place or no stop loss strategy. I would argue that your stop loss is just as important as your entry. In fact, even more so, because if you think about it, you've got to get good risk to reward on the trade with your stop, but you've also got to manage that stop as well. If the trade runs in your favor, you've got to stay with your big profitable trends as long as possible. And most traders simply cannot do this. Now, in terms of the rules themselves, I'm just going to explain the logic behind them, and you'll see why they will get the risk reward in your favor, and they're all easy to apply as well. So let's go to a storyboard and take a look at the points or rules in more detail. All right, let's have a look at 10 tips in relation to stop loss placement and, of course, managing stops as well. Now, point number one. Fairly basic points. Stops need to take into account volatility of the pair. Now, some pairs are more volatile than others, but most pairs can move 100 pips, high to low in a day, and that means that most of the time your stop's going to be more than 100 pips. You want to look at the daily chart. Don't need to do anything complicated. Just look at the size of the candles. Now, in terms of a lot of traders, they will place their stops of lower time frames, 4 hour, 1 hour, 30-minute, even 5 minutes. That is a mistake. The lower the time frame, the bigger the noise levels. So generally, you want to focus on the daily chart. Now, in terms of when you place your stop and you're entering a trade, you need to do it the right way round. Most traders make the mistake. They decide what trade entry size they want to do. It's normally too big, and then they basically put the stop too close because the trade size is big. You do not want to do that. You want to work out how much you have to risk to stop first on the trade, and that will decide your trade entry. So if you had two trades that you wanted to risk the same amount on, let's say it's 1%, one has a 100 pip stop loss, the other has to have a 200 pip stop loss because of volatility, let's say. The one with the 100 pip stop loss will be double the trade size. Okay, so do it that way round, and then you won't be tempted to put your stops too close. Now, in terms of Forex stops, when you initially place them, look for the obvious level of support if you're long, or resistance if you're short, and ignore that level. Okay, do not put your stop anywhere near it. Why? Because there's going to be stop clusters there, and what I mean by that is if it's obvious level to you, it's obvious level to everyone, and most traders will pick the obvious level. They'll put their stop a few pips behind it, and what will happen a lot of the time is that the big banks, the big hedge funds, they know this. They make it their business to take retail traders' stops. So just force the price to the level, get all the stop losses, then the price will go back the other way. And a lot of traders have this happen to them. They get taken out near the high or the low of the day, and they think their broker's done it. Their broker hasn't done it at all. It's big funds who hunt retail traders. Now, in terms of point number 4, leads on from point number 3, really. Place your stop behind the second level of support and resistance that you see on the chart. So you're out the way of the clusters, okay? If you do get taken out and stop, you're wrong. At least you're out the way of the clusters, okay? Now, in terms of point number 5, you've got to take into account round numbers and the turbulence around them. So if you've got a round number, okay, let's say when I'm talking round numbers, you've got 130 British pound, 113 euro USD. Let's say you're short of the euro. You don't want to have your stop on the round number or near it within a few pips, because again, price can be sucked towards the level. Okay, that's what big institutions do. And as a broker, most retail traders will place their stop right on the round number or within a few pips. So always be mindful of that. Okay, I normally work on the basis that I want at least 20 pips back, and normally it's 30 pips back from a round number. Funds will try and push price through the round number. Also, there's a lot of turbulence around round numbers because a lot of orders are colliding. So you want to stay out the way of that. Okay. Now, in terms of moving the stops as trade unfolds, you still want to keep it 2 levels back. Wait for a level to break on the upside if you're long, and then you can bring your stop up. Okay, but always behind the second level. What a lot of traders do, as soon as they've got some profit, they're going to move their stop to break even, so their entry price. That's a mistake, actually, because all it is doing when you do that is you're just really trying to avoid loss most of the time. Sometimes you can do it. Most time it's the wrong trade. Traders are too quick to get their stop to entry, and then they just hope it runs on. But they're too close and they normally get taken out. They'll say, well, I can't lose anything. Now playing with the market's money is a common expression. You can't lose anything, but you want to run big profitable trades. So if you keep moving your stop quickly to break even, you're more often than not going to get taken out and you've missed a great profit opportunity. Also, traders who always move their stop quickly to break even, they're not confident in their strategy. If they're confident in the trade, they'd keep their stop back. Okay, so sometimes you can do it, but most of the time it is the wrong trade to do. Now, in terms of holding big profitable trends, it's a real problem for most traders. A good way to stay with big trends is, this is what I do. I have 2 targets, okay? And at the first target, I'll bank 50% of my trade out and then let the other 50% run. So I put 50% of my profit in the bank, still got 50% in the market. Because I've got money in the bank, I don't have to move the stop too close. I can still give the trend room to breathe, so to speak, and see if the trade runs on. And it's very effective in my view, and I've seen a lot of hedge fund managers recommend banking partial profits. Okay, you're not going to get the best if it does run on, but you're certainly not going to get the worst. And when you get a big running trend, let's say it's 300 pips, 500 pips, even more than that, very difficult for most traders to stay with it. Banking 50% out is a great idea. Let the other 50% run. Also, you can drop your bank 50% back in if you wish. I think it's a great tip to keep in mind. Now, point number 8, time stops. Close of a trade does not do what you expect within a certain time period. This might apply, let's say you're doing a breakout of a big level in the markets, and your strategy is telling you that trade should run on. You break out, stall, then start to fade back. Very often, it's a good idea just to say, right, give it a day or 2 or whatever it might be, and if the trade hasn't done what I want, then I'm just going to come out the market, look for something else. Time stops can be very effective because all traders know when they're in a trade and it's not doing what they want, they kind of know deep down it's probably going to come back and take their stop. So you're better off to get out. If you've got a small profit, great. Even a small loss, just take it. A small loss is better than hitting your stop, which you initially placed, which is a bigger one. Okay, so you can just stop yourself out. Trade doesn't do what you wish it to do. Point number 9: always trade volatile pairs. The concept of moving equity. If you're in a pair, very often, traders will get stuck. The volatility will drop down, it will start to chop sideways or whatever. Very often, what you can do is if you see a pair that's more volatile or looks a better trade setup, just basically shift over to that pair and again liquidate the trade that you've got in that isn't doing anything. Okay, a lot of traders won't do this. They say, well, I got a small loss, I'll wait till it gets to break even or whatever. That's kind of stupid. Your loss is your loss. It's there, sitting there in your open equity. Go for something better. You want to be trading moving and volatile pairs. Okay, excuse me. So I will do that frequently. If I see a better opportunity elsewhere, shut down, go for it. Point number 10. This is a tip, not in relation to individual stops, but in relation to your account equity. Many traders have this. I mean, I've had it frequently. You suddenly get a big windfall profit on all your trades. They all kind of go well, or you have a big move up in your equity. Everything is going well. My own view is set a profit target. On my account, mine is 10%. If I make 10%, okay, what I'll do is I'll shut down all my positions at market, and then I'll wait and I'll reopen them the next day. The reason this is a good thing to do is basically because most traders have had this. You suddenly get a big profit and then it comes back. Okay, so also you risk it coming back, but also you get complacent when you're in big profitable trades. Everything's looking good, and you very often traders, myself included in the past, you just take your eye off the ball. Okay, so if you shut down when you've got enough profit or a specific profit target you're happy with, you can always open back up the next day. And then when you open back up the next day, you are going to be much more careful with your trades. Why? Because you've got no cushion of profit anymore in the market. And traders get very complacent with trades in the market when they've got a profit cushion. Okay, they don't see, they're not alert enough for the recoil against them. I found that tip works really well for me. It's a personal tip, but when I haven't done it, I've always seen my profits become less, and in many instances, just all the profit disappears. That's a very personal tip, though. But I think in terms of the 10 tips, if you keep them in mind, they will get the risk to reward in your favour. Many of the tips are really not doing what other retail traders are going to do with their stops, okay? And retail traders, they all mostly lose, so you don't want to be doing the same as the majority. I found these 10 tips have worked for me over the years. Some of them are my own, and others I've taken from literally trading legends, hedge fund managers, etc. But I think as a basic strategy for placing stops and managing stops, the 10 rules there will really help smooth your equity curve. Right, that is the video for today. Thank you very much for watching me as usual. Take care. Have a good day.